Today, we're embarking on a really fascinating deep dive into a company that's, well, about as familiar as a friendly face in the sky. Southwest Airlines Company, ticker symbol LUV.
hmm
Now, while many of us have undoubtedly experienced their unique onboard charm, maybe you've even got a Rapid Rewards card stashed somewhere.
Mm.
We're going far beyond the passenger experience today.
Right.
Our mission here is to cut through the noise, the headlines, the sometimes confusing financial jargon, to give you a crystal clear, comprehensive, and hopefully engaging financial analysis.
Yeah, absolutely.
We're here to unpack Southwest's current financial health, its bold strategic moves, and what the raw numbers, the recent news, and even, insider activities truly tell us about where this iconic airline is heading in, well, a rapidly evolving market.
Exactly. And analyzing an airline like Southwest, especially one so deeply ingrained in the American travel landscape and known for its distinctly unique operational model, it offers a particularly rich tapestry of insights.
Hmm.
It's not just about those traditional financial metrics. It's also about understanding the broader market dynamics and how these strategic pivots impact a company's bottom line and its future path. We'll be exploring not just what their current situation is, but critically delving into the why it matters to you as, a curious observer of the market. We'll try to connect those dots for you.
Okay, so let's begin by really grounding ourselves in the essence of Southwest Airlines.
Yeah.
Beyond those recognizable blue and red planes, what exactly defines their core business? What has historically made them such a standout player in the fiercely competitive world of aviation? What's their secret sauce been?
Well, at its core, Southwest Airlines Co. is in the business of operating and managing a passenger airline. Their primary focus, historically and still largely, is the domestic U.S. market.
Right.
In fact, within that domestic sphere, they hold a significant distinction. They are the largest domestic air carrier by passengers boarded. That's a crucial point because it really speaks to their scale and market penetration within the U.S.
Huge reach.
Absolutely. And their operational specifics are indeed quite distinctive and, frankly, a cornerstone of their historical success. They maintain a formidable fleet. We're talking nearly 800 aircraft. And here's the kicker. It's an exclusively Boeing 737 fleet.
Just the one type.
Just the one type. And this single aircraft type strategy isn't just a quirk. It's been a profound driver of their efficiency for decades. I mean, think about it. Simplified maintenance, fewer spare parts to stock, streamlined pilot training, commonality across ground crews. It significantly cuts down operational complexity and costs.
Makes sense.
It gave them a real competitive edge for a long, long time. Historically, their operational model was meticulously crafted around specializing in short-haul, often leisure-focused flights. And for the longest time, they famously operated with a single open-seating cabin configuration.
Ah, yes, the open seating.
Within a purely point-to-point network. This was a radical departure from the hub-and-spoke models favored by most other major carriers, like American, Delta, or United. While others routed passengers through massive central hubs, often involving connections, Southwest took you directly from point A to point B.
Simpler.
Exactly. That simplicity, combined with their open seating, which allowed for incredibly quick turnarounds at the gate and their famous bags fly free policy, became more than just a business model. It was a deeply ingrained brand identity. It was all about making air travel simple, affordable, and, dare I say, kind of fun.
Yeah, they did have that reputation.
It created a highly loyal customer base that valued that transparency and efficiency over, say, premium frills.
That's right. And while their bread and butter has always been the domestic market, their international footprint has actually steadily expanded over the years. It now extends beyond the continental U.S. to popular leisure and near international destinations.
Right, places like the Caribbean, Mexico.
Exactly, including the Commonwealth of Puerto Rico, Mexico, Jamaica, the Bahamas, Aruba, the Dominican Republic, Costa Rica, Belize, Cuba, the Cayman Islands, and Turks and Caicos. These aren't just random destinations either. They often cater to the same leisure-focused travelers who appreciate Southwest's value proposition.
Playing to their strengths.
And let's not overlook their ancillary services. These might seem small individually, but, collectively, they contribute meaningfully to their revenue streams. We're talking about things like early bird check-in.
Right. Pay a bit extra to board earlier.
Upgraded boarding for a small fee, or even transportation of pets and unaccompanied minors. Each of these offers convenience to the customer while quietly adding to the company's top line. It's a classic example of identifying customer needs and monetizing them without adding excessive complexity.
Yeah, it's smart. And just to round out the foundational corporate info, Southwest Airlines was founded by the visionary duo Roland W. King and Herbert D. Kelleher back on March 9, 1967. They're headquartered in Dallas, Texas, and they are a significant employer with approximately 72,450 dedicated individuals making those flights happen every day.
Wow, that's a big workforce.
It really underscores the scale of their operations.
Now, here's where things get really interesting, especially for a company that has so fiercely guarded its distinct operational model for decades.
Hmm.
In late 2025, Southwest is apparently poised for some genuinely significant strategic transformations. These could, quite frankly, fundamentally alter their passenger experience and their competitive stance in the market.
Yeah, this isn't just tweaking things around the edges.
No, this feels like a strategic pivot point. It could send ripples through their entire business and potentially redefine their relationship with that loyal customer base we talked about.
You're absolutely right. These upcoming modifications represent a noticeable shift for a company that has historically offered an almost universally uniform product. I mean, think about it. For years, every seat on a Southwest flight was essentially the same. Same pitch, same amenities. Now they're introducing some rows with extra legroom. While this might seem like just a small comfort upgrade to a passenger, for Southwest, it signifies a move towards a more tiered product offering, something more like what their competitors have been doing for years. It's a step away from that pure uniformity.
A little bit of segmentation creeping in.
Exactly. But the most significant alteration, and arguably the biggest departure from their long-standing ethos, is the planned overhaul of their ticketing process and merchandising. They will be updating their system to offer assigned seats.
Whoa, assigned seats on
Listen,
Southwest.
Assigned seats, a complete reversal of their famous open seating policy. And perhaps even more impactful, they will introduce more fare categories, including a basic economy class.
Basic economy, too.
Yeah.
Okay, that is a huge strategic maneuver.
It really is. For decades, Southwest differentiated itself by offering transparent pricing, bags fly free, open seating as part of the core value. This move signals a willingness to, well, unbundle and segment their product in ways they've historically resisted, all likely in pursuit of new revenue streams and potentially a broader market reach.
And the strategic implication of these new basic economy fares appearing for the first time in travel aggregators' search results, that's enormous, isn't it?
Oh, absolutely huge. Think about what that means for how they compete. Previously, if you searched on, say, Expedia or Kayak, Southwest flights might not even show up unless you specifically went to their website.
Right, because their bundled offer didn't fit the grid.
Exactly. It didn't fit neatly into the aggregator's comparison grids. Now, by offering a basic economy fare, they're essentially stepping onto the same playing field as every other airline. It moves them into a more direct side-by-side price comparison with their legacy competitors American, Delta, United, especially on price.
So they'll show up in those searches for the absolute cheapest fare.
Precisely. It's a clear strategic move to capture a segment of the market that might previously have overlooked Southwest. It makes them visible to a wider audience actively searching for the cheapest available ticket. It's a bold step, designed to bring them new customers, potentially boost load factors, but it undeniably carries both significant opportunities and, well, inherent risks to their long-cultivated brand identity.
Yeah, you wonder how the loyalists will react.
Exactly. It's almost as if they're saying, okay, we're done being unique in this specific way. We want a piece of that price-sensitive pie. This change alone has the potential to redefine their market perception and their customer acquisition strategy. It's a calculated risk, betting that the increased visibility and new revenue will outweigh any potential alienation of their traditional fans.
Okay, let's peel back the layers now and unpack the numbers, and specifically the market sentiment surrounding Southwest, especially in light of their recent earnings report. It certainly looks like they've been hitting some significant turbulence in the skies of Wall Street. The stock performance seems to reflect that pretty clearly.
That's certainly one way to put it. The recent stock performance tells a story of significant headwinds. As of August 11th, 2025, that's your data point, Southwest's last closing price was $29.06. On that particular day, it experienced a negative shift, down about 56 cents, which translates to a 1.89% decrease.
Okay, a down day, but what about the bigger picture?
Right. To truly grasp the depth of this turbulence, we need to zoom out. Looking at various timeframes, the picture becomes clearer and, frankly, a bit rougher. The stock was down 2.32% in the last week. Over the last month, it plunged a significant 21.73%.
Wow, over 20% in a month. That's a substantial hit.
It really is for a major airline in such a short period. The last quarter saw a 6.80% decline, and over the last half year, it was down 6.26%. Year to date, the stock has fallen 13.56%. So these figures collectively signal sustained selling pressure and, well, a loss of investor confidence over the medium term.
And when you analyze its 52-week price range, that provides even more context, doesn't it? The high point over the past year was $37.96. That means the current price is a considerable 23.45% lower than that peak. On the flip side, the 52-week low was $23.82, and the current price is about 22% above that absolute low. So while it's not scraping the bottom, it's certainly much closer to its 52-week low than its high. That reinforces the narrative of a downward trend from its recent peak. Suggests investors who bought near the top are feeling some pain.
No doubt. And the volatility metrics further confirm this choppiness and, frankly, unpredictability in the stock's movement. We're seeing a daily volatility of 2.41% and weekly volatility of 2.98%. The average true range, or ATR, is 1.02.
Okay, ATR, that's a measure of the typical daily price movement.
Exactly. It measures market volatility, indicating the average range between high and low prices over a given period. An ATR of 1.02, especially with these percentage swings, suggests that Southwest stock is experiencing relatively significant daily price movements, roughly $1 per share swing on average.
So pretty jumpy.
Yeah, this kind of volatility can be a double-edged sword. It presents opportunities for nimble traders, maybe, but it also indicates higher risk for long-term investors looking for stability. It highlights that the market is really struggling to settle on a fair valuation, constantly reacting to new information.
Now, a truly critical moment for LUV, and frankly, a point that set ripples through the entire airline industry in Wall Street, was its Q2 2025 earnings report. This report came out July 24, 2025, and it painted a particularly grim picture. The headlines certainly didn't pull any punches. Beyond just reciting them, what was maybe the single biggest shocker in that report that reverberated through analyst calls, and why?
Well, the headlines themselves, as you said, tell a very clear story of struggle and disappointment. Things like dismal earnings, weak outlook, Southwest Air LUV nosedives 11% on dismal earnings, Q2 earnings and revenues lag, decrease year over year, and Southwest results are hurt by depressed demand for air travel.
Yeah, not great.
Not great at all, but the single biggest shocker, the one that really made analysts sit up and take notice, I think, was the reported $1 billion profit cut from tariff fallout. That specific figure was a massive hit to their bottom line, and it immediately raised questions, especially for a company like Southwest that has traditionally focused so heavily on the domestic U.S. market.
Right. Tariffs are on imported goods. How does that hit a mostly domestic airline for $1 billion?
Exactly. That's the question. This isn't just some generic tariff impact. Given Southwest's exclusive Boeing 737 fleet and the, complex global supply chain for aircraft manufacturing, it's highly likely this hit comes from tariffs on aircraft parts, components, maybe even delays or cost increases on new aircraft deliveries. Tariffs on steel or aluminum, for instance, fundamental to building planes, could significantly increase their input costs.
Ah, the supply chain aspect.
And while primarily domestic, Southwest does operate international routes. If certain tariffs affected international travel demand or supply chain costs for those operations, that could also contribute. It really tells us about the interconnectedness of global trade, even for a largely domestic airline. It highlights a vulnerability in their supply chain resilience to geopolitical and trade policy shifts. And look, $1 billion is not a small chunk of change for their profit margin.
No kidding.
It underscores how these external macro-level factors can disproportionately impact even well-run companies in capital-intensive industries like airlines.
And looking ahead, that Q2 report didn't just reflect past struggles. It cast a shadow on the immediate future too, right? The Q3 outlook was explicitly described as rocky. That immediately sparked doubts over a steep Q4 profit climb.
Yeah, rocky is not what you want to hear. For an airline, that means continued uncertainty around passenger demand, maybe volatile fuel prices, perhaps ongoing labor challenges. It suggests the path to recovery isn't expected to be smooth or quick. Any hope for a strong rebound later in the year is now met with significant skepticism from the market.
Raises real questions about demand, especially after what should have been peak summer travel.
It does. However, it's crucial to balance this, largely negative news with a contrasting, more optimistic note. On the very same day that dismal earnings report dropped, July 24th, Southwest CEO offered a glimmer of hope. He stated, quote, "In the past month, we're seeing the beginning of an inflection back up."
Okay, so dismal report, but the CEO sees an inflection back up. How do you square that?
That's the critical question, isn't it? Is this genuine optimism, perhaps based on very recent booking data that analysts don't have yet? Or is it more like strategic framing of the narrative, an attempt to instill confidence after such a significant earnings miss?
Right. Damage control, maybe?
It could be. Reconciling such a dismal report with the CEO's claim of an inflection back up truly highlights the divergent views on Southwest's immediate future. It forces us to ask, is the worst truly behind them? Are they seeing genuine signs of recovery? Or is the path still going to be bumpy, with continued challenges that might make that inflection short-lived?
And it's important to remember, it's not just Southwest experiencing these ups and downs, right?
Yeah.
We've been seeing broader trends impacting the entire airline sector. Suggests some of these challenges and maybe some of the hopeful signs are more industry-wide than just specific to LUV.
That's absolutely right. For example, we saw news from August 5th, 2025, indicating that U.S. travel bookings rebound for August, boosting companies' revenue outlook. Now, that could certainly be a positive sign for the broader sector, maybe pent-up demand or a shift in consumer spending towards experiences like travel, a potential tide lifting all boats, as they say.
Okay, some positive momentum there.
But then you have to contrast this with earlier news from July 10th, 2025. While Delta's earnings report did lift airline stocks on that particular day, acting as a sort of industry bellwether, some analysts, perhaps cautiously, warned that it may be a premature celebration.
Ah, the classic analyst caution. Why premature? What were they worried about?
Well, when analysts warn of a premature celebration, what specific concerns are they usually highlighting? They might be worried about rising fuel costs, which are notoriously volatile and a massive expense for airlines.
Always a big one.
Always. Or perhaps ongoing labor disputes and pilot shortages, which continue to put upward pressure on wages and create operational headaches. There's also the persistent issue of air traffic control staffing shortages, leading to delays and cancellations, impacting efficiency across the board.
Right, the system constraints.
Exactly. Plus, fleet delivery delays from manufacturers like Boeing, which Southwest relies on exclusively, can hinder growth plans. And of course, the ever-present threat of a broader economic slowdown hitting discretionary leisure travel again. So while a rebound in August bookings is welcome news, these systemic issues facing all carriers might limit any sustained recovery. It could easily turn a short-term celebration into a longer-term struggle.
So underlying structural challenges remain.
Precisely. It underscores the complexity and, frankly, fragility of the airline industry as a whole. Seemingly good news can often be shadowed by these persistent issues.
Okay, let's shift gears and really unpack what these detailed financial metrics tell us about Southwest's current state and its future potential. This is where we get into the nitty-gritty, moving beyond headline into the hard numbers.
Absolutely. Let's start with their core valuation metrics. Southwest has a market cap of $15.26 billion. This figure, represents the total value of all their outstanding shares, gives us a sense of the company's size in the public market.
Okay, about $15 billion.
Mm-hmm. Complementing this, their enterprise value stands at $16.76 billion. Now, enterprise value is often considered a more comprehensive measure of a company's total value. It accounts for market cap plus debt, preferred stock, minority interest, minus cash. For an airline, which often carries significant debt to finance its fleet, the enterprise value can give a more accurate picture of what it might cost to acquire the whole company.
Got it. So slightly higher than market cap due to debt, presumably.
Likely, yes. Now, let's dive into the price to earnings, or PE ratio. They're trailing 12 months. TTM PE is quite high at 43.70.
43. That is high compared to the broader market average, isn't it?
It is, yes, significantly above the historical average for the S&P 500, which often hovers around, say, 15 to 20. A high trailing PE suggests investors are either paying a substantial premium for current earnings or, more likely in this case, that current earnings are unusually low, which pushes the ratio higher.
Okay, makes sense given the recent struggles.
But here's where it gets truly interesting. Their forward PE ratio, which looks at expected earnings over the next 12 months, drops dramatically to 12.53.
Wow, from 43 down to 12.5. That's a massive drop.
It's a huge reduction, and it's a clear signal. It tells us that the market has very specific and, frankly, very high expectations for a rapid rebound and a substantial increase in Southwest's future earnings. It signifies significant investor optimism for a turnaround. It indicates the market views the current low earnings as temporary and anticipates a swift return to profitability. It's almost as if investors are placing a strong bet on those strategic changes we talked about actually paying off.
That's a huge difference indeed. So to break down the earnings per share, the EPS that feeds into those PE ratios, their TPM EPS is a modest $1.67.
Yeah.
But the projected EPS for next year is $2.32, which, as you said, implies that massive 157.65% growth.
Astonishing jump, isn't it?
It really is. Certainly reflects that turnaround optimism. We also see an EPS next 5-year growth projection of 50.48%, indicating sustained long-term optimism beyond just the next year. However, and this is absolutely crucial to highlight, their EPS for this year is actually projected to be down 6.26%.
Right. So near-term pain before the gain.
Exactly. It underscores the current challenges we discussed from their Q2 report. It means they're facing a dip right now before that anticipated robust recovery. So it's really a tale of two outlooks: current struggles, but strong future expectation.
And that ties directly into the PEG ratio, which stands at 0.87. Now, for those unfamiliar, the PEG ratio, or price earnings to growth ratio, builds on the PE by incorporating the expected earnings growth rate.
Great.
PEG ratio below 1, generally speaking, often suggests that a stock may be undervalued relative to its expected earnings growth. So despite the current struggles and that high trailing PE, the market is pricing in so much future growth that Southwest looks relatively attractive based on those future expectations, according to this metric.
Interesting. But how reliable is PEG for an airline, given all the volatility?
That's the million-dollar question, isn't it? It's a useful tool, but growth in this industry can be highly cyclical, intensely impacted by external shocks, fuel prices, pandemics, tariffs, as we saw. It doesn't always fully capture the inherent risks. We can also briefly touch on other valuation multiples, each providing a different lens. Price to sales, PS, is 0.56. Price to book, PB, is 1.91. And price to cash, PC, is 3.98.
So PS useful when earnings are down, PB for asset-heavy companies.
Precisely. PS gives a measure relative to revenue, which might be more stable than earnings right now. PB shows how the market values their physical assets, all those planes. And PC gives a quick check on cash generation, different angles on valuation.
So given all these valuation numbers, how efficiently is Southwest actually turning its vast sales at $27 billion into profits? What do their margins tell us about their operational discipline?
Good question, because this is where the rubber meets the road, so to speak. Let's look at their core profitability metrics. Their income is reported at $397 million, generated from those sales of $27.47 billion. When we break that down into margins, we see a gross margin of 17.73%.
Okay, nearly 18% gross.
But then the operating margin is just 2.3%, and the net profit margin is a thin 1.45%.
Oof, 1.45% profit margin. That's incredibly slim.
It is. These figures are quite revealing. While 17.73% gross margin indicates they're reasonably profitable on the direct cost of their services, flights, baggage handling, etc., a 1.45% net profit margin means for every dollar of sales, they're only keeping about 1.45 cents as actual net profit after all expenses, taxes, interest. It starkly highlights the intensely competitive and high-cost nature of this business. Volatile fuel prices, significant labor costs, maintenance, airport fees, aircraft depreciation, they can quickly eat into revenue, leaving very little room for error. It shows that even small fluctuations in costs or demand can have a disproportionate and quite painful impact on their bottom line.
Those are indeed tight margins, underscoring the tough economics. Now, how effectively are they using their assets and their shareholders' capital to generate these profits? That's where return on assets, ROA, return on equity, ROE, and return on invested capital, ROIC, come in. We see an ROA of 1.24%, an ROE of 4.30%, and an ROIC of 3.05%.
Yeah, and these are important because they show how efficiently the company is leveraging its resources. A low ROA, like 1.24%, particularly for an asset-heavy industry like airlines, suggests they aren't generating a significant amount of profit from their massive asset base, those hundreds of expensive aircraft, terminal space, ground equipment.
So the capital invested in assets isn't yielding huge returns right now.
Seems that way. It indicates relatively modest returns on that capital, and the recent sales and EPS growth rates further emphasize the recent volatility and the path they're navigating. Sales year-over-year, YY, for the trailing 12 months show a modest 1.64% increase, some top-line growth.
Okay.
However, sales quarter-over-quarter, QQ, reveal a decline of 1.50%. That points to the recent weakness we saw in Q2. For earnings per share, we see a robust YY TTM growth of 284.24%.
284%. That sounds amazing.
It does, but it's crucial for our listeners to understand context here. Such a high percentage often comes off a very low base from a prior period, likely reflecting a strong recovery from pandemic-induced dips or other past challenges. It's the comparison point that matters.
Right, recovering from a deep hole.
Exactly. And in stark contrast, their EPS QQ quarter over quarter plummeted by 31.03%. That directly ties into that negative Q2 earnings report we discussed earlier. So we're seeing it rebound from historical lows, but significant recent pain quarter over quarter.
Gotcha. A mixed bag on growth.
Very mixed. And to further confirm that negative sentiment surrounding their Q2 performance, let's look at the EPS and sales surprise percentages. Southwest reported an EPS surprise of negative 15.93% and a sales surprise of negative 0.71%.
Meaning they missed analyst expectations on both earnings and revenue.
Correct. A surprise indicates how much the actual reported numbers deviate from what analysts had collectively forecasted. These negative surprises mean the company failed to meet those expectations, which, as we saw, certainly contributed to the stock's nosedive right after the Q2 report. It underscores that the company underperformed against market consensus, further rattling investor confidence.
Now let's pivot from profitability and efficiency to Southwest's ability to meet its obligations, both short-term and long-term. This is where liquidity and debt management come into play, crucial elements for any company, but especially for capital-intensive airlines.
Absolutely critical. Starting with liquidity, Southwest has cash per share of $7.31. This tells you how much cash they hold on a per-share basis, which is, a decent buffer. However, when we look at their quick ratio, it's 0.49, and their current ratio is 0.56.
Okay, quick and current ratios below 1. What does that signify?
For our listeners, the quick ratio measures a company's ability to meet short-term obligations with its most liquid assets, excluding inventory. The current ratio is similar, but includes inventory. Both of these ratios being below 1 generally indicates potential short-term liquidity challenges.
Meaning they might struggle to cover immediate bills with readily available assets.
Potentially, yes. It means their current assets, the stuff that can be quickly converted to cash, may not be sufficient to fully cover their current liabilities, things like accounts payable, short-term debt, upcoming operational expenses like fuel and wages. In a capital-intensive and high cash burn industry like airlines, managing cash flow and short-term obligations is always critical. These numbers suggest a tighter situation than ideal, possibly requiring very careful cash management.
That's definitely something to keep a very close eye on them. And for the longer view, how's their debt situation look? Especially given the massive capital expenditures required to run an airline. We see a debt-equity ratio of 0.67 and a long-term debt-equity ratio of 0.62.
These ratios indicate moderate levels of debt relative to equity. Now, in the airline industry, which is inherently capital-intensive again, think about the enormous cost of buying, maintaining, upgrading aircraft fleets. Some level of debt is not only expected, but often necessary for funding operations and expansion.
Right, it's hard to buy planes with just cash flow.
Exactly. So while these levels are moderate, it's a critical area to monitor. Why? Because the airline industry is highly sensitive to interest rates, which directly impact the cost of servicing that debt. Furthermore, in periods of economic downturn or reduced demand, like what we've seen hints of, a higher debt load can become a significant burden. It makes it harder to fund necessary fleet modernizations, technology upgrades, or even just weather unexpected shocks. So while not alarmingly high right now, maintaining a healthy debt-to-equity balance is vital for long-term stability and flexibility in this sector.
Southwest has historically been known for being one of the more consistent dividend payers in the airline industry, which isn't always common. What's the story there, especially in light of these detailed financials we've just discussed? Are they still delivering for shareholders, and crucially, is it sustainable?
They are indeed still committed to paying dividends, which is certainly a positive signal for income-focused investors. The estimated annual dividend is $0.72 per share. That translates to a dividend yield of about 2.46% on an estimated basis, or 2.48% based on trailing 12-month figures.
Okay, around 2.5% yield. Might look attractive to some.
It might, especially in a low-yield environment. However, a key figure here that warrants close scrutiny is their payout ratio. It's notably high at 95.45%.
Whoa, 95% payout. That means they're paying out almost all their earnings as dividends.
Pretty much. The payout ratio indicates the percentage of a company's earnings paid out as dividends. While a high payout ratio means a very large portion of earnings are distributed directly to shareholders, it also carries significant implications and potential risks.
Like what? What are the risks?
Well, firstly, it leaves very little room for reinvestment back into the business itself. Things like critical capital expenditures, fleet modernization, technology upgrades, or just building a robust cash buffer. In a capital-intensive industry like airlines, reinvestment is crucial for staying competitive and funding growth.
Right, you need money to buy new planes eventually.
Absolutely.
Yeah.
And maybe more critically, such a high ratio makes the dividend potentially vulnerable if earnings fluctuate downwards, which is particularly relevant given the sharp Q2 results we just discussed and the general volatility of the airline sector. If their profits continue to be challenged, maintaining that high payout could become unsustainable or severely strain other essential areas of the business.
So it could be at risk if earnings don't recover as hoped.
It certainly raises that question. Though on a recent note, Southwest did declare its 186th consecutive quarterly dividend on July 31st, 2025. So that underscores their ongoing commitment to shareholder returns, at least for now. They're sticking with it.
The raw numbers provide a powerful snapshot, definitely. But how are key stakeholders, we're talking analysts, company insiders, large institutional investors, how are they reacting to Southwest's trajectory? Their actions and sentiments can often provide another layer of insight, sometimes more forward-looking.
That's where we turn to stakeholder sentiment, exactly. Let's start with analyst recommendations. The consensus Recom score for Southwest currently stands at 3.08. Generally, on a scale where 1 is a strong buy and 5 is a strong sell, a 3.08 score falls squarely into a hold or neutral category.
So analysts are mostly sitting on the fence.
Pretty much. It suggests that, on average, they aren't overwhelmingly bullish or bearish. They're largely taking a cautious, wait-and-see approach, perhaps hesitant to commit to a strong stance given all the mixed signals we've been discussing.
Okay. What about their price targets?
The average target price from analysts is $31.69. That suggests a modest upside, maybe about 9% from the current stock price, around $29.06. However, what's truly fascinating here, and perhaps more revealing than the average, is the sheer frequency of shifts in analyst ratings over the past year. We've seen a remarkably mixed bag of activity.
Lots of changes up and down.
A lot. There have been several notable downgrades from reputable firms. For instance, HSBC Securities downgraded them from hold to reduce in July 2025, right around that challenging Q2 earnings report. Evercore ISI went from outperform to inline around the same time. Jefferies, JP Morgan, BofA, and Citigroup also issued downgrades in late 2024 and early 2025.
So a cluster of downgrades around the bad news.
Exactly. That concentration clearly reflects a rapid recalibration of expectations based on that disappointing performance and outlook. But it's not all doom and gloom on the analyst front, right? There have been some upgrades mixed in there as well.
Right, you mentioned upgrades too.
Correct. On the other side, we've seen upgrades from Deutsche Bank, Jefferies at a different point earlier in the year, UBS, Melius, Argus, and Evercore ISI, also at an earlier, more optimistic point. This mixed bag and the frequency of these rating changes truly reflect the deep uncertainty and the differing opinions among experts regarding Southwest's future.
Yeah, it sounds like the experts are divided too.
They really are. It highlights how quickly sentiment can pivot based on new information, especially earnings reports. It tells us that analysts themselves are wrestling with the question, are Southwest's struggles temporary, or are they indicative of deeper structural issues? The volatility in recommendations really speaks volumes about a company at a significant strategic crossroads.
Now let's turn our attention to what those closest to the company, its own executives and directors, and maybe even political figures are doing with their shares. Looking at insider and congressional trading activity often provides a unique, albeit often speculative glimpse into confidence levels, or at least how these individuals are managing their personal portfolios.
Right. We see that insider ownership stands at 1.11% of the total shares. And insider transactions, reflecting recent buying and selling activity, show a net positive figure of 0.66%. Digging into the specifics, there's been some noticeable recent insider buying activity by multiple directors in early to mid-2025.
Okay, directors buying shares, that usually sounds positive.
It often is seen that way. For example, Sarah Feinberg bought shares in August and March. Greg A. Sorensky made purchases in August and April. And Pierre R. Breber, David P. Hess, C. David Cush, Patricia A. Watson, Christopher P. Reynolds, they all bought shares between March and April 2025. These purchases were often at prices ranging from, say, $26 to $31, which is around the current stock price.
So buying near current levels.
Exactly. When multiple directors are buying shares at current levels, it often signals a collective vote of confidence. A belief, perhaps, that the stock is undervalued or that the worst of the downturn is behind them. It's like they're putting their own money where their mouth is, investing alongside shareholders.
Okay, that's the buying side. What about selling?
Well, we also have to contrast this with some proposed sales. Officer Ryan C. Green proposed a sale in June 2025. Linda B. Rutherford, a chief administration officer, executed a sale back in December 2024. And a more significant transaction was a sale by Elliott Investment Management.
Elliott, the activist investor.
The very same. A known activist investor and, at the time, a 10% owner of Southwest. They sold a large block, over 1.2 million shares, in October 2024. Now, Elliott is known for taking significant stakes, pushing for changes, and then often exiting after they believe their objectives have been met or their investment thesis has played out.
So their selling could mean something different than an executive selling. Maybe they think the changes they wanted are happening or the easy money's been made.
It could imply that, yes, it's definitely a different signal entirely from the director buys. It adds another layer of complexity to interpreting insider activity.
And crucially, Executive Chairman Gary C. Kelly also purchased a substantial amount of shares in September 2024. Given his prominent leadership position, that move definitely signals confidence directly from the very top, suggesting a belief in the long-term prospects back then.
A significant signal from leadership. Moving to congressional trading, it presents another interesting, albeit often debated, layer of activity. House Representative Ro Khanna, a Democrat, shows a pattern of frequent, typically smaller trades, ranging from $1,001 to $15,000. Lots of purchases and sales of LUV shares over the past few years.
Frequent small trades, maybe active management.
That pattern is quite common for some congressional members who might be actively managing their portfolios, perhaps through independent financial advisors. Beyond Representative Khanna, other members like Gilbert Ray Cisneros Jr., Dan Sullivan, Dwight Evans, Dan Crenshaw, Kathy Manning, Pat Fallon, Diana Harshbarger, Tom Suozzi, and Victoria Spartz have also traded LUV shares, though often less frequently.
Any larger trades that stand out?
We did see some larger transactions. Pat Fallon, a House Republican, and Victoria Spartz, another House Republican, both engaged in purchases and sales in the $100,001 to $250,000 range. Those are more substantial amounts compared to the typical smaller trades, indicating a more significant financial position in the stock for them.
So what does this all mean when we look at both insider and political trading? This pattern offers a unique, maybe speculative, glimpse into sentiment, or at least activity. But it's really important for our listeners to remember these trades can happen for a wide variety of reasons, right? Not just a direct bet on the stock going up or down.
Absolutely. That's a critical caveat. Insiders might be diversifying their personal portfolios after accumulating significant company stock, or exercising stock options and selling shares simply to cover taxes, or for personal liquidity needs, buying a house, paying tuition, whatever.
Yeah, life happens.
Exactly. Similarly, politicians might be following the advice of financial advisors, making trades for personal liquidity, or managing their portfolios according to pre-scheduled plans that don't necessarily reflect a direct vote of confidence or no confidence in the stock's future. It's an interesting data point to consider in the overall mosaic, sure, but it's definitely not a crystal ball for predicting stock movements.
Okay, good perspective.
And finally, let's complete our picture of market sentiment by looking at institutional ownership and short interest. Institutional ownership stands at 100.01%.
Whoa, wait. 101%. How can institutions own more than 100% of a company?
Yeah, that number always catches people's attention. It sounds impossible, right? It usually indicates one of two things, or often a combination. It can suggest a significant amount of shares are held through derivatives, which complicates the counting. More commonly, and relevant here, it signals that there's considerable short interest in the stock.
Ah, the short sellers.
Exactly. This happens when shares are borrowed from institutional holders, pension funds, mutual funds, and then sold by short sellers. This effectively creates phantom shares in the market, which can push the reported institutional ownership figure above 100% when you count both the original shares held by institutions and the shares they've lent out to shorters.
Got it. So high institutional ownership can actually point towards significant shorting activity.
It often does. And supporting this, the institutional transaction data shows a net institutional selling of negative 4.42%, meaning institutions collectively sold more shares than they bought recently. That aligns with the negative sentiment we saw around Q2. And then there's a short float, which is 6.83%, with a short ratio of 3.01.
Okay, what do those mean in plain English?
Short float tells us that almost 7% of the publicly available shares are currently sold short. The short ratio of 3.01 means it would take about 3 days of average trading volume for all those short sellers to buy back their shares and cover their positions. This represents a substantial 35.45 million shares currently shorted.
So a notable portion of investors are actively betting against the stock price rising.
That's what it indicates, yes. They expect it to fall. Now, high short interest can sometimes precede what's known as a short squeeze if unexpected positive news emerges, forcing short sellers to buy back shares rapidly, driving the price up. But in this context, it primarily signals significant bearish sentiment among a segment of the market. It reflects a lack of confidence in Southwest's near-term prospects or a belief that their challenges will persist. It's definitely a data point to watch closely as their strategic changes unfold.
Moving beyond just the raw financial numbers now, let's explore the operational innovations, the external pressures, and the broader strategic decisions that are actively shaping Southwest's future, particularly as they adapt to this changing market and evolving customer expectations. This is where we see the company trying to navigate the complexities of its business model in real time.
Right. And a significant point here, one that connects directly back to our earlier discussion about Elliott Investment Management, is the recent corporate governance changes. On July 31st, 2025, Southwest Airlines announced the naming of Doug Brooks as its new board chairperson, and this was specifically accompanied by an Elliott statement on Southwest governance changes.
So Elliott explicitly commented on the change.
They did. This directly links back to Elliott, who we noted was that 10% owner and executed that significant share sale back in October 2024. This strongly suggests that their involvement, likely as an activist investor, may have directly led to these governance shifts, particularly the change in board leadership.
So the activist pressure resulted in a new chair.
It seems highly likely. Activist investors often push for strategic and governance changes they believe will unlock shareholder value or improve company performance. A change in board chairperson is a common outcome of such pressure. It indicates that external forces are pushing for potentially a new strategic direction and financial improvement at the highest levels. It signals a responsiveness to investor demands, even if those investors, like Elliott, are now selling down their stake.
Interesting dynamic. Turning to the political and regulatory landscape, Southwest has consistently engaged in substantial lobbying efforts. We see quarterly spending figures like $410,000 in July 2025, $300,000 in April 2025. This consistent, significant spending highlights the ongoing and critical need for airlines to influence policy and navigate a heavily regulated environment. But why these specific issues they lobby on?
That's a great question, because looking at the issues sheds light on the myriad pressures an airline faces. Consistently, they lobby on aviation, airlines, and airports. That makes perfect sense, right? Obvious operational and regulatory reasons. But they also engage on homeland security issues. That directly impacts airport security protocols, passenger screening, the flow of travel, all critical to their operational efficiency. Their lobbying on budget and appropriations could relate to federal funding for airport infrastructure projects, maybe air traffic control modernization, or even specific grants that could benefit the industry.
Okay, infrastructure funding makes sense.
When they lobby on banking and taxation internal revenue code, they're likely pushing for favorable financial regulations, perhaps specific depreciation schedules for their massive fleet, or tax credits related to fuel or sustainable aviation fuel, things that could reduce their operational burden and improve their bottom line.
Gotcha. Tax stuff.
And their focus on consumer issues and safety products is vital for managing their brand and ensuring regulations don't unduly restrict their offerings or increase compliance costs. Historically, they've also lobbied extensively on fuel, gas, and oil, a direct reflection of fuel being their single largest variable cost. This diverse range of issues really illustrates the incredibly complex and heavily regulated environment an airline navigates. Seemingly distant policy decisions can directly impact their operational costs, revenue, and overall profitability.
Yeah, they have to watch Washington closely.
Yeah.
And on the flip side of government relations, let's look at their government contracts. While recent General Services Administration, or GSA, contracts show $0 for 2023-2025, which might seem surprising, it's worth highlighting their substantial Department of Defense, DoD, contracts in 2021-2022.
Military travel.
Right. This includes a significant $3.5 million contract and a $1.4 million contract. among many smaller ones. This indicates their notable role in government travel, which can help diversify their revenue streams beyond just commercial passengers. While commercial travel often fluctuates with economic cycles, government contracts can provide a more stable, albeit perhaps lower margin revenue base.
Good point. A reminder that airlines serve various customer segments, including large institutional ones like the government, that depend on their network for essential travel.
Now, Southwest has always had this deeply ingrained customer identity, particularly with its cherished open seating and simple fare structure. Given this strong brand loyalty, how are their recent strategic changes, particularly those aimed at reshaping their product, actually landing with that loyal customer base? Are they seeing the impact they'd hoped for yet?
This is perhaps the most critical question for Southwest's future right now. And news from July 30th, 2025 provides a, well, pretty sobering initial answer. Southwest, after overhauling customer offerings, fails to see a measurable impact.
Ouch. No measurable impact yet.
Apparently not, according to that report. This is a significant insight into the initial reception of their strategic shifts, especially considering the planned, even more dramatic changes coming in late 2025. The article directly addresses the new seat policy and the money grab narrative that has been gaining traction, particularly highlighted by outlets like the Wall Street Journal.
The money grab narrative.
Yeah,
Because they're starting to charge for things that used to be included or didn't exist.
precisely. The narrative stems from the perception that Southwest, long celebrated for its all-inclusive, transparent pricing and open seating, is now adopting the unbundling tactics common to other airlines. By introducing basic economy fares, charging for extra legroom seats, and eventually moving to assigned seating charges, some longtime loyal customers feel they are losing that unique value proposition and simplicity they cherished.
So they feel like it's just about squeezing more money out of them.
That's the perception described. It implies these changes are solely about extracting more revenue, rather than genuinely enhancing the overall experience for their existing customer base. It suggests that their efforts to modernize and increase revenue might come at the cost of alienating the very customers who built their brand.
That's the core tension, isn't it?
It really is a fundamental strategic tension. Will these changes ultimately improve revenue and profitability by attracting new, price-sensitive customers through aggregators? Or will they dilute the essence of the Southwest brand and alienate its traditional loyalists without sufficient new market capture? It's a very, very fine line to walk in the airline industry.
And it's not just about changing their core product internally. They're also strategically forging new partnerships and expanding their network in ways that signal their broader ambitions, right? We've seen Peace Coffee become their official in-flight coffee partner starting August 13th, 2025.
The coffee upgrade?
While it might seem like a small amenity, it's part of a broader trend of airlines trying to elevate the onboard experience. Is this a response to premiumization by competitors, or maybe an attempt to soften the blow of other changes, like assigned seating, by offering a perceived upgrade elsewhere?
Could be a bit of both. Then there's that new agreement with Priceline, announced August 6th, 2025. This means direct flight availability will appear on that major aggregator. This is massive for those new basic economy fares we discussed.
That's them right in front of shoppers on Priceline.
Exactly. It directly boosts their online presence and accessibility to a much wider audience, especially those actively searching on third-party sites. And they've introduced new benefits on Southwest Rapid Rewards credit cards with Chase, announced July 24th. That seems like a clear move to enhance customer loyalty and perhaps lock in their existing frequent flyers before the new fare structures potentially alienate them.
Smart timing, maybe.
Potentially. And beyond these partnerships, they're actively planning network growth. An expansion to St. Thomas, U.S. Virgin Islands, is slated to begin early 2026. This indicates strategic route development, aiming to capture new leisure markets and potentially higher yield traffic as part of their broader expansion.
Looking for growth in new places.
And finally, it's worth just briefly noting their patent portfolio. It highlights their internal commitment to operational innovation and customer experience improvements over the years. This includes patents for things like a detection system, a provisioning cart for on-aircraft restocking, hinting at efficiency behind the scenes, a fare availability calendar, systems for schedule optimization, and even power stations for personal electronic devices.
Oh, innovating under the hood, too.
Exactly. These patents reflect a company that has, over the years, invested in proprietary technology to improve everything from ground operations to the passenger's in-flight experience. These are the silent innovations that keep a large airline humming and competitive, regardless of the public-facing strategic shifts we've been focusing on.
Okay, so we've just navigated the complex and, well, sometimes turbulent skies of Southwest Airlines' financial and strategic landscape. We started by understanding its deeply unique core business model, delved into its recent performance turbulence driven by those disappointing earnings, meticulously analyzed its detailed financial metrics, and explored the influential hand of stakeholders and the ongoing operational innovations and external pressures it faces.
To recap, Southwest Airlines finds itself at a truly fascinating juncture. It's attempting to balance its deeply ingrained historical strengths and that beloved brand identity, particularly the open seating, the simple fares, with these bold new initiatives like assigned seating and a tiered fare structure.
A real balancing act.
It really is. All of this is happening while navigating a volatile market, battling significant external pressures like tariffs, and dealing with wavering investor confidence, as we saw in the stock performance and analyst ratings. The financial indicators we discussed suggest both persistent headwinds in the short term, clear from the Q2 results, but also hint at significant potential for future growth. That forward PE and the growth projections show that. But it all depends on execution, doesn't it?
Right. If these strategic shifts are executed effectively and are ultimately well received by customers, old and new.
Exactly. And this complex situation raises an important and, I think, thought-provoking question for you, our listener, to consider. Given Southwest's historical brand identity, that whole vibe of open seating and simple, transparent fares, which fostered such fierce loyalty for so long, and given its current financial challenges prompting these radical changes, how do you think these significant operational shifts will ultimately impact its competitive position and its loyal customer base in the long run? Will this be a successful evolution that propels them forward into a new era of profitability, maybe capturing market share from competitors? Or will it inadvertently dilute the very essence that made Southwest unique and beloved by so many, risking their core identity for what might seem like short-term gains? It's a massive strategic tightrope walk they're on right now.